Okay, it looks like we're live. Probably need my microphone. I didn't even ever pull that down, but all right, here we are. Sound looks like it's good. Internet looks like it's good. Welcome, everybody. Good morning. Good morning. Welcome to Midas Investing Live. I have some interesting stuff to show you guys today. A lot has happened since the last time we did a show 3 weeks ago. I was planning on doing a show last week. We did have FG report its earnings after all, but I spent all of last weekend really kind of like rebuilding up a pretty detailed model for FG, what with the 10K having coming out. And I had wanted to go live and discuss it, but at the same time, I just ended up using so much of that time doing doing the work and stuff, which is often how I end up missing shows for my every other week schedule. Is that I'm often just so in some sort of research project or some sort of something or other that I'm just like, well, you know what? I could just stream next week. I can always just stream next week, right? But anyway, here we are. Welcome Sunday. But in the interim, we have had even more happenings occur. I remember that last week, I'll just kind of start off with that, what sort of my original plan was, because there was, we'd had a little bit of a dip in the market alongside FG having reported its earnings, but there had also been this report going around that was causing a lot of the volatility in the market, which I was originally sort of planning to kind of discuss last week, which I'm probably not really going to discuss in high detail, but I'll bring it up here just in case anybody hasn't actually really heard about it. But there is this research group or fellow out there by the name of Citrini who I had heard the name and had seen some of his research and had seen some podcasts where the owner of the company had talked before, and I'd always been very, very impressed by the level of kind of fundamental and macro research that the person brought to the table. But they had put out this report here, what they call the 2028 Global Intelligence Crisis, which is basically a sort of doomsday scenario of sorts regarding uh, the AI industry and essentially like how it could cause massive disruption throughout the economy. So if you haven't read this, I guess I would suggest maybe going and reading this. Like I said, it was kind of all over the headlines a week ago, and it has since been supplanted by the new headlines. But it's an interesting article, so it's definitely worth reading. Though I would say that don't take everything in it for granted, and even they say that this is supposed to be like a worst case, very doomsday scenario that they themselves don't even really believe in necessarily. I think it's near the end of the article that they say that there are specific elements of the dominoes that they kind of like paint here that they would very specifically disagree with. So it's like this is not to be even be taken as like something that even they specifically agree with. It's just kind of like a thought experiment of like what could go wrong. But the reason why I was originally kind of planning to bring it up last week, though, is because yeah, obviously it's AI, and so it's related to the broader market and the trends and whether or not our bull market continues or whether or not we go into a bear market and things like that. But the specific scenarios that they paint is actually relevant to things that I discuss here on the channel. That being annuity insurers and the private credits that back them up. Like I said, you got to read it all yourself, but they get very much into the details of how FG, my top position and has been top position for quite some time, relates into this. Though that has to do partially with the type of assets they're backing and stuff like that. Like I said, read it yourself. I don't, like I said, don't even fully agree with it. I would only maybe agree with like uh, 30 to 40% of the things that are in the article itself, but it was all over the headlines of the Wall Street Journal a week ago, that's for sure, which I thought was interesting. I was like, oh wow, look at this article from this macro researcher that I've been familiar with suddenly is all over the headlines. But like I said, that was last week because obviously in since then we have now also begun a uh, a military conflict between the United States and Iran, as well as other countries in the Middle East that are involved in that in whatever form they are. But for my interest being that I'm a United States citizen and Iran, or Iran. So that has now been the new headlines, obviously, all over the news. And not to take a slight victory lap on that, but it's only partially related because I wasn't projecting necessarily a war, though that those types of conflicts was certainly something in my mind at the time. But obviously, a couple months ago or a few months ago, I think it was December, maybe it was the first time I started talking about it. I had been calling out on the oil price and had basically been saying, hey, when the oil price kind of gets sub 60 into these kind of 50s ranges, that there really is a sort of floor that exists based off of the amount of producers that start to go unprofitable at a certain point down here. And so it depends on the dynamics, the kind of competitive dynamics that are going on there in terms of like when people actually start to cut their supply. But the point is once you get down to these kinds of levels, eventually supply has to start being cut off, which means that there is essentially a floor um, to the to the price somewhere. Not a literal floor, but like there is a point where it starts to bounce back from, and that is kind of somewhere in the 50 to 60 range, depending on how you estimate. Like I said, it could always go lower, but the point is at some point or another it would have to snap back. So I was looking at lots of oil names, and I know like I had talked about a decent amount of the oil names that I had looked at. I had gone and done some basic valuation work on like about 10 of the top oil names globally or particularly North American or European companies. I didn't really focus so much on the larger Chinese players, for example. But nonetheless, we were looking, and I had commented that I had liked BP to a certain extent, and I had liked Canadian Natural to a certain extent. I think I had said that I also liked Shell to a certain extent, but BP was definitely the one that I thought was the most attractive. And I didn't buy BP for my personal portfolio, but for some of the other managed portfolios that I operate, I did put it in. So it's not for my portfolio here that you guys get to see, but nonetheless, BP was a company that I was sort of long in some form or another. I was certainly taking positive bets on it. And I would say that also near the end of December or mid January, my sector rotational strategy had also put me into VDE, which is the Vanguard Energy ETF, as well as PSCE, which is a small cap energy ETF as well. So my macro strategy system had identified energy as starting to break out as well, which I mean, over here, take a look at, we can see that has indeed been popping. This is VDE, the large cap energy, and then PSCE, you can see here is Invesco small cap energy, which you can see is way down from highs back in 2014, but in terms of this kind of short-term move, it has been starting to pull up. So that's been interesting stuff here in the last couple of weeks. So we're going to talk a decent bit about FG here today, since the earnings did come out some time ago at this point. I did kind of want to go a little bit deep into their presentation and the 10K and kind of discuss a variety of things, kind of give a sort of recap, I guess, on like, what FG is, what they're doing, what our perspective is. Like I said, I've been working on a very detailed kind of three-statement model. I'm trying to like model out not just the income statement, but also the balance sheet and the cash flows over a 10-year period. So I've been doing a lot of kind of like deep work and trying to model that, which I had done last year for the record. That was the very, very long stream that I did with FG. Really, I'm basically just kind of redoing the model that I made last year. But the model I made last year was like very, very messy. It was very, very not cleanly put together. It was a huge kind of chaotic mess on the spreadsheet. So I'm really trying to kind of clean up basically the model that I made last year. But for the most part, it's largely kind of based on the same approach. But before we get into that, I did want to do an overview of my business cycle model, which I've shown several times over the last year, year or so, year plus. But I have reworked it pretty significantly since the last time I showed it, and I've kind of like put things in place to make it so that the kind of iterating of the data as it comes in and the re-analyzing of it will be a little bit more easy for it to be somewhat automatic, which means that hopefully I can be able to kind of create a somewhat regular cycle to when I go over it. And that's included for a bunch of other the economic data that I've gone over on the channel here at various points in the past. I'm trying to kind of create a sort of regular schedule, so to speak, of when I go over economic data and then which economic data at which points. So new system sort of beginning to get today. We'll see how that goes. But anyway, coming over to that, I actually have that in uh, presentation form. So which kind of helps with what I was saying about trying to put it in a way that all of the economic data I try to analyze here on the channel will now kind of hopefully all filter into this presentation, whether it's coming from spreadsheets that I have put together myself or from the Federal Reserve website, like the little graphing system that I've shown many times together. I've created basically these presentations that kind of brings all of that data together and then sections it out to different types. So here is the business cycle analysis, which I've shown several times before. Is different parts of the business cycle, which includes like a liquidity cycle, a cycle to stock returns, the credit cycle, which is like extension of loans, the cycle to profits specifically to the equities, to stocks, growth, which is like GDP growth, employment, which I have here as unemployment, but you can see it says that it's inverse. So like when it shows employment, like the unemployment rate going up, it would actually have the line going down because basically all of these signals are oriented so that basically the negative or the bad outcome or the outcome that the signal moves towards as you're going into recession is on a downward trajectory. So for unemployment, it's specifically an unemployment rate, and it's the black line here. So you can see the black line going down. That's actually the unemployment rate going up, just so you can sort of understand what inverse means. But policy, that refers to the federal funds rate, which is basically the same thing, that if the federal funds rate is going up, that actually the line goes down in this analysis. And then inflation. And then also I included the yield curve, which isn't really a cycle per se. That isn't really an aspect of the business cycle, but it is a signal within that. In fact, technically, I would say it relates closely to the liquidity and credit cycles, but it also sort of has a little bit of a sentiment aspect to it because interest rates are prices. So there's kind of like a pricing aspect to the yield curve itself. But anyway, that one is also inverse. And in a sense, you could say that the employment and policies are also not really a cycle because employment will stay statically positive unless the other cycles are falling apart. Which at the end of the day, that's kind of the point of this business cycle analysis, is really trying to predict is employment going to fall off a cliff? People tend to talk about the economy and more often than not using GDP growth as kind of like they're the most like stereotypical headline metric to, like, if you want to encompass the entire economy, what's going on in the economy, and down to one number, people will often say, well, what's GDP growth doing? And that's true that GDP growth and employment are highly correlated with each other, so that does make sense. But at the end of the day, it's really the employment thing that we care about the most, which is why, for example, you can have periods, occasional periods of time where there will be 1 or 2 quarters of GDP growth that is negative, and the kind of traditional rule of thumb is that it's a recession if you have 2 periods of quarterly GDP that are negative. But truly, that's not actually the case because it requires unemployment to actually fall apart. It's just that when you have 2 quarters of GDP go negative, historically speaking, like 90% of the time, you also have employment falling off a cliff at the same time. So that's kind of where that kind of confusion comes from. But anyway, nonetheless, looking within these cycles here, the point of this analysis is that there is a sort of regularity to the way in which these signals break down in and around recessions, and all of the cycles, meaning all of these ones listed here, except for the yield curve, as I said, and the employment and policy, because those aren't really cycles; those are just kind of like static figures. But liquidity, stocks, credit, profits, growth, and inflation all have a certain level of momentum to them. The inflation that you had last month and the month prior to that is very, very likely to be pretty close to the inflation that you're seeing in the next month. And I'm referring specifically to the month over month figures. So if you're looking at a year over year figure, technically there's basing effects in there that you would have to account for. But in terms of like, does the most recent signal have any sort of impact or say on what is likely to be the next part of the signal? That is very much true when it comes to liquidity, stocks, credit, profit, and growth and inflation. So that's kind of the point of this analysis, is that you can follow these and get an idea of like what's breaking down in what order, to get an idea of how likely it is that you are currently close to a recession. And then also you can use the momentum of the individual signals itself to get an idea of, okay, well, how likely is it that then we would be going into recession maybe over the next 3 to 6 months, so to speak. And spoiler alert, the kind of summary of this is that as it currently stands, the current dispersion amongst the component signals is not indicative of recession. Several signals are mildly negative, but trending upward, while few are following the archetypical recessionary pathway. So here you can see the archetypical recessionary path as the signals decline and then start to recover at different paces and at different regularities. But here, looking at where all those signals currently are, there are several that were negative, but the ones that are negative are actually sort of trending towards positive. There are several that were positive and still just kind of like trending sideways. And there isn't really very many that are kind of really trending towards the negative, other than I would say the employment measure here, which, as I say, the employment measure really sort of is, at the end of the day, the most important of these measures. However, in itself, on a downward trend, even when it's still in positive territory, is not particularly recessionary signaling, especially if you have the other signals, like, for example, especially credit and profits, because credit and profits are probably the most correlative signals out of all these to employment. If credit falls apart, you have to lay people off. If profits fall apart, you have to lay people off. If that may hopefully sort of make sense. So while employment is downtrending here, credit is uptrending, and profits is kind of going flat. And if credit is uptrending, it's very likely that profits would start to potentially uptrend. And if profits uptrend and credit uptrends, then you're not likely to have employment fall apart. So anyway, moving forward with that, looking at each of these individually, here showing the yield curve value, here showing the stereotypical pathway way of the yield curve through the recessions. And as I was talking about, this is inverted. The yield curve measure is inverted. So we normally have an inverted yield curve, which means it's sort of in negative territory. And as the recession begins, it becomes positive. However, the inverted yield curve is essentially a semi-positive factor because of the way we see it go into recession. So I have it inverted, so it's positive before the recession and negative going into it. So it's just kind of a, like I said, an orientation, because we want all the signals to essentially be positive before the recession, negative in the recession, and then positive as you recover out of recession. So all of them have been oriented in that way. And also, so it's clear, each of these metrics are roughly equivalent to the same thing, which is a 6-month annualized rate of change that has a 3-month smoothing to it. And then we're taking the standard deviation over the 10-year average for each of them. That's what each of these lines are. So they are roughly comparable to each other, with these metrics giving you a standardized, adjusted metric that tells you over the course of the whole business cycle how abnormal is this metric currently. So if it's over 1, that means it's at least 1 standard deviation above the norm of the most recent business cycle. So here you can see the yield curve was inverted, over 1 standard deviation inverted, and then it has started to uninvert, as I said before. Like, going down in this particular chart is an uninversion of the yield curve over the course of basically the last 1.5 to 2 years or so, and it has moved back towards into the negative territory, which means the yield curve is actually flipped roughly positive. And it, as you can see here, this one is actually a little bit ahead of schedule relative to what the recession is. So this is actually, out of all the signals, probably one of the ones that is most indicative of a recession. However, it's not causal. As I said before, there's nothing about an inverted yield curve going positive that necessarily causes the recession. There's elements to it that can impact whether a recession occurs, because, like I said, this is really a pricing measure that relates back to the credit cycle and liquidity cycle. And so the fact that you have an inverted yield curve and it goes positive could be indicative of weak liquidity and credit. However, it's not necessarily the case. So we'll hold our tongues on that essentially until we get to that measure there. So here I actually I have roughly kind of the similar stats like this for each of these metrics, as you'll see, where I show the current value, which is negative 0.39, and then I show the kind of like the typical levels of these. This shows the typical pathway in and around recession, but I took a look at the total level of the data and said, okay, well, what is the usual behavior of the actual metric around the recession? So the median at the start date of the recession is 0.59, which is positive. You would actually expect it to be negative if it was a particularly strong signal. So that actually goes to show how the yield curve can sometimes be wrong. This is less consistent. Like, if you would want this to be very consistent, you would want all 3 of these to be negative, and then you would want both of these to be positive, because this is in recession and this is in expansion. So the median at the start of recession is positive, the median of during all the months of the recession is negative, and then the median low point reached between all of the different recessions is negative 1.23. So you can see two of them ended up being negative, but one of them ended up being positive. And likewise, in the signal and expansion is actually the median value during an economic expansion is actually negative. It's just mildly negative. And then the median high reached during an expansion is positive 1.34. So again, if this was a very consistent signal, you would want both of these to be positive and all three of these to be negative. And then the core data trend refers down to this chart here, where I show in the blue line the actual yield curve as it currently stands. So not like a standard deviation metric as it's shown here. This is the actual yield curve. And then I have 3-month, 6-month, and 1-year averages. So you can get an idea of like how in line are these moving averages relative to the actual metric. And you can see that they are all stacked well on top of each other, with the 6-month on top of the 1 year, the 3-month on top of the 6-month, and then the actual metric on top of the 3-month. So a strong positive impulse to the yield curve, showing that it is likely continuing upward, which means that this line would likely continue downward. So moving on from that to the next metric, we have liquidity. Liquidity, which I measure using the M2 money supply, but specifically the real M2 money supply. So I have divided the M2 money supply by the CPI inflation index, and then taken the 6-month annualized rate of change of that, and then the 3-month average of that, and that's what this signal shows here. And here you can see the typical pathway in and around recessions, where it's often in somewhat negative territory and struggling to recover until it finally fails to properly recover, and then drops down into negative 1 standard deviation territory before eventually starting to recover maybe about a year into the recession. And then looking at the current signal, you can see it's been in kind of negative-ish territory for well over 2 years at this point. I think it's actually kind of more like 3 years at this point, 4 years, because the liquidity started falling apart after interest rates started dropping. But you can see it is slowly moving towards positive territory. So this is one of those signals that I was talking about, where it's like this signal is weak, it is in negative territory, but it's actually in kind of a recovering trend point. So that's not necessarily something that indicates we're likely to be going into recession. It's something that indicates that we're actually potentially moving away from the recessionary potentials. However, again, still not out of negative territory yet. However, in terms of the actual value of it, where the value is currently negative, it's a negative 0.26, and the median at the start of recession is negative 0.68, median during recession is negative 0.79, and the median low reach is negative 1.31. So you can see, like, even though we're, yes, at negative territory here, we're nowhere near the consistently negative values that you see in recession for liquidity. And then in expansion, you can see that it is consistently positive. The median value is a positive 0.12 in an expansion, and the median high reach is 2.37. So very, very strong levels of liquidity during the positive impulse parts of an expansion. So point being that this is a very consistent signal, and we're not anywhere near the recessionary levels. And then looking at the actual core data rather than a normalized trend, as we show here, this is the actual real M2 on a year-over-year basis, and we have the 3-month annualized rate of change and the 6-month annualized rate of change. And so here I would define this as a weak positive impulse. It's positive because the 3-month annualized rate of change is higher than the 6-month annualized rate of change. So the most recent data shows an improving momentum impulse. However, the 6-month annualized rate of change is lower than the year-over-year rate of change, which means that it's positive, but it's not necessarily a very strong trend. So we do have a positive trend, though, to the real M2 growth, which gives indication that this would likely still continue to trend higher, unless this the weak positive would devolve into maybe a negative impulse. So moving on from that, we also have stocks. Stocks, the current value is at 0.81. That's versus a median negative 0.51, negative 1.13 median during recessions, and a negative 2.1 of a median low reach recession. So you can see a very, very consistently negative archetypical deviation level during a recession. And you can see the current value as it stands here versus the archetypical pathway. The signal during expansion, typically quite positive, 0.2, median high reach 1.98. So you can see very, very consistent signal stocks are. And here it shows we have a weak negative impulse. Negative because the 3-month rate of change is lower than the 6-month rate of change, but the 6-month rate of change is still higher than the year-over-year rate of change of the CPI adjusted S&P 500. So it is a weak negative impulse, but perhaps that signal will flip back positive potentially. We'll see in the short run. But as we see here, the adjusted level is still quite high, so it would actually have to devolve negative for a decent period of time for it to really kind of reach the recessionary levels. So moving on from that, we also have credit, which I define credit as the commercial loans and leases level, which is reported by the Federal Reserve. And then I also do a CPI adjustment for this metric as well. And here you can see that the standard deviation metric was negative for quite some time. As I was kind of pointing out, the liquidity and credit were both pretty negative for several years and then have been starting to recover. Liquidity recovering slower than credit, but here you can see credit has actually properly recovered into positive territory, which is very counter to the recessionary outcomes. And as I pointed out earlier, credit and employment are highly correlated with each other for causal reasons. So it's very unlikely that employment can continue to weaken, but employment's not likely to fall off a cliff if credit is not falling off a cliff. Because the point is that there's no reason to be laying off all your employees if you can always just take out more credit, is basically the kind of the causal logic there. And I pointed out earlier that the profits is also highly correlated with employment for basically similar logical reasons and logical kind of like thought experiments. So here you can see the current value, a positive 0.31. The median at the start of recession is quite solidly negative at 0.6. Median during recession is close to 1 standard deviation in negative, and the median low reach a negative 1.66. So you can see very consistently negative during recessions. We're not negative at all right now. Signal and expansion quite significantly positive 0.36. Then the median high reach during expansion 1.62. So quite positive during an expansion. And then at the core data itself, the real commercial loans and leases on a basis, a very strong positive impulse with the 3-month annualized rate of change higher than the 6-month annualized rate of change, which is higher than the year-over-year basis. So I would actually say that like this metric right here is one of the more bullish aspects, in my opinion, of the economic data right now, is that it's very hard for a lot of things to really fall apart economically if the commercial banks are out there loaning like mad, which is basically what has been going on for the last year or so. So this is definitely one of the more positive signals. And it's one of the reasons why when I see the kind of more kind of negative looking aspects of the employment data, because as I said, the employment data has been clearly downtrending for years. But when I look at this alongside the employment data, it gives me a lot of confidence that the employment data has to sort of bottom eventually somewhere, and that and also the employment data doesn't show a falling off a cliff. It just shows a downtrend, which is pretty atypical. Usually when employment data starts to deteriorate, it usually deteriorates at a very accelerating rate. So the fact that we've had employment data deteriorating at a decelerating rate is very atypical, and it kind of gives an indication that there's a bottoming effect going on. So anyway, getting ahead of myself there, but profit here showing profit, which is defined as the S&P 500 EPS, but CPI adjusted. Now, I'll give a little bit of a caveat to this because it does show here in the most recent data showing a negative territory, but I do know that there's a bit of a delay in the data sourcing that I have for this data that is making basically the fourth quarter data EPS data coming in a little bit delayed, and so that's actually causing this to go negative when it otherwise wouldn't. Like I don't know exactly where it would, but the yellow line would maybe be like right around where the red line probably is. It wouldn't really be just as negative as it looks here, so it kind of makes this look like it's deteriorating at a faster clip than it really is. However, within that logic, just kind of going with it, the current value is negative on the standard deviation metric, but just barely, negative 0.09, whereas the signal recession is negative at the start of recession of 0.51, so we're nowhere near where the start of recession kind of level is. The median during recession is solidly below 1 standard deviation, and the median low point reach is 2 standard deviations. So very solidly negative metric when we are in a recession. In an expansion, it is pretty typically positive on a median basis, and the median high reach is close to 2 standard deviations up. So a very cyclically consistent signal. And then in that core data trend, I'm calling it a weak positive impulse because, like I said, I do think that like the yellow points here, this is not an accurate representation of the data, but I'm not 100% sure where it would line out here. However, we do see the 6-month annualized rate of change is lower than the 12 months. So basically, I'm going to kind of artificially claim that the yellow is maybe above the red, but then the red is still below the blue, which is what I would call a weak positive impulse. So that'll be corrected by the time the the next signal shows. So moving on from there, we have growth, which is defined as real GDP growth. Here showing that we're currently in a positive trend value of 0.08, so just barely in positive territory, but positive nonetheless. Signal in recession is pretty solidly negative with negative 0.42 at the start, negative 1.34 on a median basis throughout the entire recession, and then negative 2.08 as the median low point reached across all recessions that we've seen in the data series. And then pretty solidly positive in expansion, 0.23, median high reached in expansion, 1.59 positive standard deviations. So you can see, looking at where it is, it's kind of been trending sideways here, generally speaking. We've had some up points and low points, but kind of just trending sideways, which is fine. Like I said, this data doesn't require it to be. That's true, by the way, of pretty much all these data series, is that these data series don't require them to be heavily positive. They just require, as far as like the standard deviation metric, they just require them to not be negative. Because if they're not negative, that means they're trending about their 10-year average, which means they probably are in positive territory down here or wherever. Right? Like that's just kind of the way you interpret this, is that this is a heavily normalized version of this data, and then this data is like the actual raw data itself. So like this is the actual real GDP on a 3-month, 6-month, and year-over-year basis. The 3-month being the headline metric that is reported on the news for GDP. And then here, I've normalized it both across the metrics individually, so I can compare them to each other, but also across business cycles so that I can compare them across time. But anyway, going with that, here we do have the 3-month annualized rate of change is lower currently than the 6-month annualized rate of change, which is higher than the 12-month rate of change. So that shows a weak negative impulse to GDP currently speaking. Moving on from that, we're at employment. Employment is one of our inverted metrics. So the employment rate, if you see the employment rate going up, it actually shows a downtrend in the data because it's oriented so that essentially the negative or recessionary orientation of the data is going to be negative to the downside. So that's just kind of like how I have this data oriented. So here, current value is 0.11, so it is downtrending, heavily downtrending over the last couple of years, but still in positive territory, 0.11. Median at the start of recession is 0.17. So here, similar to the yield curve, how I pointed out that the yield curve is actually a kind of inconsistent in terms of like how well it lines up with recessions in the data. I showed like there was some positives and negatives kind of mixed together in weird ways. Well, employment also has that problem. Employment has a positive value on a typical basis at the start of recession. Which is consistent to how I've described the employment metrics when talking about this analysis before in the past, is that the employment is literally like the last part of the economy to fall apart. It is the thing that breaks down the last. Well, okay, that's not entirely true. Inflation actually breaks down after employment. However, inflation going down is kind of a good thing for the economic system, right? I mean, it helps the recovery. So really, you can focus more on the fact that the inflation tends to actually be rising prior to recessions and then breaks down after the employment itself breaks down. But the employment breaks down after GDP breaks down, which breaks down after profits have broken down, which breaks down after credit has broken down, which breaks down after liquidity has broken down. Generally, like I said, it doesn't have to always go exactly in that order, but it is pretty typically in that order. So because of that, employment being so late to the party whenever a recession starts, and when a recession starts, it's actually usually in positive territory. So that's, whoops, let me go ahead there. So that it is a little bit inconsistent in that way. However, the median value during a recession is negative. It is about almost half a standard deviation negative. And then the median low reached in across all recessions is negative 1.68 or 65. So you can see it does tend to decline pretty significantly there. And then the signal in expansion is on a median basis negative. So you can see that even in an expansion, it doesn't necessarily mean that employment has recovered very, very quickly. It's like here you can see almost 3 years after a recession has begun, employment is still significantly negative. So if a typical recession maybe lasts only like 2 years or so, then this would be showing how like even though the expansion has already begun, employment on a kind of deviation over the 10-year average basis has not necessarily fully recovered. However, the median high reached in expansion is still positive 0.56. However, I'll point out that that's the high reached. the high reach, the median high reach, which for that metric across most of these, it was usually pretty high, at least as one standard deviation, if not like two, right? Like that was the typical levels reached for this particular type of metric. So just goes to show that, coming back down to the employment, that this is like the yield curve, not a very consistent metric for trying to say, are we in recession right now, and do we have any sort of predictive confidence of looking forward 3 to 6 months from now to say, okay, well, are we going to be in recession then? We don't have that kind of confidence when it comes to employment metrics. And the reason why is because employment is like the single most defining feature of a recession. So you can't look at the current employment data to figure that out. It's basically too late. You're kind of like too late to the party by the time you have the employment data. Keeping in mind that all this data comes in at a lag, right? All this data comes in at a lag. At a very minimum, you get the data like well, I guess for the stock data, I get that basically the next day, technically speaking. But for the rest of them, you get it like at least 2 weeks later, if not close to 2 months later for the GDP growth data. So, for example, all this analysis, I didn't even mention at the start, this analysis is as of the end of January. This is the January data. This includes all January data, but it doesn't include any February data. And that's why I'm giving it to you here at the start of March, is because you get the January data during February. And I waited until the end of February because I specifically wanted to get the Q4 GDP metric. And so you can see that even in growth, this data is as of December, and I get it at the end of February. So there, you see there's a lag there, which is why it matters to, as I said at the start, the ability to kind of have the momentum aspect of being able to look forward on the core metrics and the normalized metrics to say, okay, well, which way are we trending with all of this information? So with that, coming back to the employment data, I will still look at the trend. And here the trend, you can see the blue line is the actual unemployment rate. We have the 3-month average, the 6-month average, and the 1-year average. And you can get an idea, okay, like how is it trending? We're clearly trending upward in the unemployment rate. And the 3-month average is actually exactly equal with the 6-month average right now, and the 6-month average is higher than the 1-month average. So I will call that a strong positive impulse, even though technically the 3-month and the 6-month are the same right there, but it's still roughly above it. We'll call that a strong positive impulse. So yes, the employment data is still trending in a negative direction. However, like I said, going back around to credit and profit, they're not falling off a cliff. Credit has been kind of trending sideways, but credit has been trending upward. And also liquidity has been trending upward. So liquidity, credit trending upward, profits trending sideways. It kind of makes me feel like employment, while it is trending downward currently, is not likely to fall off a cliff. Like I said, not everyone agrees with that logic. But moving on, also we have the policy. As I mentioned at the start, policy, similar to employment and the yield curve, it's not necessarily a cycle per se. It's more of like a state that has been determined based on other factors. Like employment is really the result of all the other cycles. The yield curve is a pricing metric. So in a sense, it's dependent on liquidity, growth, inflation, credit, and sentiment to a certain extent. But policy is dependent on inflation perceptions and growth perceptions, but also political dynamics. So it isn't really a cycle per se, even though, yes, it does still tend to have a little bit of a cycle to it because it does trend along other cycles. But anyway, looking at the metrics themselves, though, here on the normalized deviation basis, and also, by the way, in this metric, I'm looking specifically at the real federal funds rate. So the federal funds rate adjusted for inflation, because that is essentially the real thing that matters. So here you can see it has been trending downward over the last 2 years as both rate cuts have occurred, but also as inflation has the decreases in inflation have moderated out to essentially kind of a low level. Because by the way, as inflation comes down, if you're not cutting rates fast enough as inflation comes down, it actually causes the real Fed funds rate to go up, because essentially you're not cutting at the same pace as inflation is going down. But so you sort of get the inverse of that. If inflation was coming down and then inflation starts to kind of level off, but then you're still doing rate cuts, it somewhat increases the rate at which the real federal funds rate decreases. So there's basically pointing out how the real Fed funds rate can decrease through two ways. You can have rate cuts, but you can also have changes in inflation. So that's just the factor there. So anyway, the real value on the normalized basis is positive 0.78. The median at the start is 0.48. So this is another metric that shows that like at a start of recession, you're actually usually still in positive territory. And here showing kind of the median pathway for that, you can see how it's actually often tightening slightly. You actually often have a little bit of a tightening factor going into recession. Not necessarily an extreme level of it, but there is often a tightening going on. And that may be due to those inflation changes. It may not have been that they were raising rates per se. It may have been that inflation was coming down and they weren't cutting rates fast enough. And so it was kind of causing a tightening in the economy incidentally. Like I said, it's not necessarily that they were increasing it per se, because there's two factors that affect this. But nonetheless, it's positive going into recessions. And then once they see often the deterioration, usually in the employment metrics, that's usually when they start to cut the rates down here. And then you can see it often stays down for quite some time. So median at the start, positive 0.48, median during recession, negative 0.92, so close to 1 standard deviation, and then median low reach close to 2 standard deviations. You can see over 2 standard deviations. And then during an expansion, the median is actually still negative, but close to zero, very, very close to zero, so kind of close to whatever the 10-year average was. And then the median high reach during expansion is 1.67, so significantly above, a deviation and a half above. And then down here, I'm not showing like a trend or a 3-month average or 6-month averages like I've done with a lot of the other metrics, because like I said, it's not really a cycle. You can look at the 3-month and 6-month averages and maybe there's some information in there, but it probably says a lot more about, like I said, the other things that affect whether or not they raise or lower rates, which has to do with growth, inflation, credit dynamics, and some political aspects as well. So in here instead, I just showed the federal funds rate, the annual rate achieved for each of the years, and then also in here it shows the FOMC SEP projections, the current median projected pathway over the next few years. So you can see, yeah, we are still projected to have the rate come down. This is the nominal rate though. I didn't include inflation in this. So like I said, this metric up here is dependent on the inflation. So if you were to include kind of thinking about inflation at this, if we're expected to have a cut or two this year, a cut or two the year after that, and then flat after that, you have to say, okay, well, is inflation coming down over the next year or two? And I mean, I personally think that inflation is probably going to stay basically around where it is for the foreseeable future, for the most part, because of structural reasons that don't have anything to do with inflation or tariffs or a lot of other things that people tend to focus on when it comes to inflation. But that's my personal take. So anyway, if that's true, if inflation is going to stay roughly where it's been at for the last 6 months on average, and then you have Fed funds rate coming down, then that means that the real Fed funds rate would indeed be coming down because inflation is staying flat there. So that means that this would continue to trend down within that. So that's basically what I would expect from that right there. So then with that, the last of the cycles that does need to be looked at would be the inflation cycle. And here you can see the archetypical pathway of inflation. This is one of those ones that's inverted for the way you orient it. You're kind of thinking of it. So when you see the recessionary pathway is the line going down and then going up, this is actually inflation increasing and then inflation decreasing, because we consider high inflation damaging to the economy and likely to cause a recession. So that's why it's oriented to the negative side for that. But here, this is the actual CPI, 3-month annualized rate of change, 6-month annualized rate of change, and the year-over-year CPI metric. So within that, you see the current value for the normalized metric is positive 0.15. So inflation has been coming down. You can kind of sort of see like a slight upward trend in this red line here, and that would be a slight downward trend in the CPI over the last 2 years or so, which, like I said, I think is basically leveling off. I think where CPI is likely to kind of stay roughly where it's at, give or take. You know, it can oscillate quite a bit, but I think if you're looking at like 3-year averages of CPI for the next 10 years, I suspect it probably won't move necessarily that much. But that's my own personal takes on that. But anyway, signal in recession, you can see it does tend to be pretty negative at the start of recession, which means inflation is pretty high relative to the 10-year average going into recessions. And then the median during recession is negative 0.96. So despite the fact that inflation has already begun, inflation tends to stay pretty high relative to the 10-year average during the recession. And then it often still reaches a pretty high level of negative 1.64 before it actually breaks down. And as I've kind of mentioned before, the thing that it tends to break down following is actually employment. It's usually once employment breaks down that you finally get a breakdown in inflation, or therefore a reversion back to the kind of pre-recessionary levels. And then here, like I said, looking at the actual levels here, the 3-month annualized rate of change is lower than the 6-month annualized rate of change, which is higher than the 12-month rate of change. So that's a weak negative impulse. So there has been a little bit of a downtrend in the short term, but it's kind of a weak trend. We don't really have a lot of confidence in that being a proper downtrend. And I would actually look at kind of like for example, here, the year-over-year metric, you can see that over a 1.5 to 2 year kind of basis, it does kind of have this kind of little oscillating level here. So I think we're really just kind of at the bottom of the oscillation is basically what I think is happening right now. So yeah, those are all the cycles. We within that we can put them all together. Here I have in this metric over here going back to the 50s. It takes a look at basically the median of each of those values. So like in this, I had the actual current values there. If you take the median value across all of those across time back to the 50s, here you can see how the metric behaves, and then the blue bars are the periods that are defined by the NBER as a recession. Now, as I've said, I did this analysis many times in the past, and I showed it on stream various times in the past, and so I've been kind of re-tinkering it in various ways. I'm actually a lot happier with the current version of it than I was with previous versions of it. Previous versions, I did a pretty good job of being able to identify recessions, but they weren't super consistent. There was plenty of false positives, but there was also period recessions where they were late to the party, where like the metric didn't really go negative until like halfway through the recession. And so in my opinion, it wasn't really properly identifying them well enough. And so here I will point out here that you can see that there is false negatives. Like I said, there's plenty of periods of time where it's negative and it's not in recession, because really you have to break down to like more than half a standard deviation or at least one standard deviation below before you really reach a recession. However, unlike the previous versions of this analysis, this version isn't really late to the party for any of them. I would say the closest call here is in 2000, where it doesn't go negative until like a month or two into the recession, but that's not too bad compared to like halfway through it, especially the 2000 recession, because the 2000 recession was a relatively shallow recession where a lot of parts of the economy still continued to thrive, even compared to the recessionary part. So that actually kind of makes sense for that recession in particular, if you understand the dynamics. And the new version of the signal is early to the party, actually more often than not. But I'm okay with being early to the party. I just don't really want to be late to the party, if that makes sense. Like, I'm okay with having false negatives, and I'm okay with being early to the party, as long as all recessions are very negative, not just slightly negative. They're very negative, and you're not late to the party, which this new version of the signal does a lot better of a job in that way. And like I said, like looking at the actual kind of metrics here, that kind of tells you how well it did, you can get an idea for that, where the current value, positive 0.1, the median at the start of a recession is negative 0.43. So that's exactly what I want. It's like the median point that it is at when a recession begins is already pretty significantly negative. So that's already an improvement from the previous versions of this analysis. The median during recession close to -1 standard deviation, median low reach close to 1.5 standard deviations down. Signal during expansion, positive, slightly positive, but positive. And the median high reached during an expansion, not quite 1 standard deviation, but almost 0.8 standard deviation, so pretty good. So I feel a lot better, much more confident with basically the ability of the composite signal to really predict recessions. I was always pretty happy with the component signals, but once you put them together into that composite signal, it's just how well does that actually tell you? Like, is it give you a high level of confidence that you can say whether you're in or not in a recession in that given moment? And then also looking at the composite signal relative to the archetypical pathway, you can see that here's the archetypical pathway it takes during the recession. As I said before, it is pretty significantly negative, typically at the start of recession. And so the red line shows where that composite signal is currently, and I also realign it to 6 months ahead to get an idea of, well, what if it began 6 months ago? How does that compare with it too? And in either case, does it particularly look that way? So both, like I said, the fact that we're in a positive value now, also, as I point out, the kind of general trends for most of the key aspects of the data as it implies, putting all that together, highly unlikely that we're in a recession right now, or likely to be in one in the next 6 months. That's basically the conclusion that I can come to with this analysis. So yeah, that's my business cycle model. Like I said, pretty happy with a lot of the changes I've made to that since the last time I showed that on stream, which was probably like 6 months ago at this point or something like that. I'm not sure when I showed it last, but pretty good with that. Jeff, I see you joined the chat too. I don't know how long you were in there. Maybe you just commented that, but maybe that was like 10, 15 minutes ago. But hey, welcome to the chat. I am doing pretty great. So now that we've covered that, which, like I said, I plan to try to do that more regularly, every 3 months. I plan to do that. And then also, my plan is to do kind of deep dives into each of the component signals to a certain extent as well. Like I'm going to have like little separate analysis that I do on the growth cycle, on the liquidity cycle, on the inflation cycle, on the credit cycle, employment. So I'm going to have separate streams where we have little deep dives on that as well. But here is kind of like my overview of the business cycle, which I plan to do at least once a quarter. So who knows what happens after 6 months from now? And like I said, I say 6 months, but really, it's sort of a rough estimate to say how long that could give you. Like I said, I plan to redo that analysis 3 months from now. So who knows that it's possible that 3 months worth of data actually changes what you believe over the next 3 to 6 months, which means that what you believed about 6 months, 3 months prior might have been slightly wrong. But that's the point. Like you update your data, which is as what is referred to in statistics as a Bayesian analysis, is that you use the most current, most up-to-date data to give yourself to best say what you think the data says now, and then 2 3 months from now you forget what you said 2 3 months later or previously, and you just look at the current data now to say, okay, well, what do I think now is it say, and you just completely forget what you said previously. So I do this analysis now, and 3 months from now I'm going to analyze the data the same way, and we're going to completely forget what we said here today, because who knows, maybe the data evolves in a way that completely changes it. So today I say that over this next 6 months, I think it's very unlikely we have a recession. But who knows? 3 months from now, maybe the data has somehow evolved in a way where I suddenly think that it could be a recession in the next 3 to 6 months. But it's unlikely, like I said, because of the way there is momentum in a lot of these time series. It's very unlikely, in my opinion. But nonetheless, that's Bayesian analysis, which is how I try to do economic analysis here. So with that, another comment from Jeff. Jeff, I did have a question on the annuity distribution chart. Is that favorable or neutral for FG? Negative? What do you mean annuity distribution chart? You mean from the report? You're talking about the part of this the AI report where they're talking about the annuities, or something else? But this is the message you sent me on Discord saying the gotcha. Gotcha. No, that wasn't that wasn't related to annuities. Wasn't the thing I sent you related to property sales? Hold on a second. Or did I send you something else? I might send you something else. Because I kind of do want to bring that up. Yeah, because that's and I didn't necessarily say super clearly what was when I sent that to you, so that might have been partially my fault for not even fully clarifying what it was that I sent. Yeah, but it is related to the FG story, because it at least still relates into the overall narrative that we've been kind of talking about, which is that there is the wealth transfer going underway. But I was just seeing that as a really good piece of evidence here. So this is what I had sent him. I found this. I think it was a Wall Street Journal article that was showing this. Oh no! It was a podcast episode on YouTube that I found this. Somebody had posted this in California. So this is California property transfer. So real estate property specifically. So it didn't specifically say like what kind of transfer it was. So that's, yeah, I get understand why you might have thought it was something else entirely. But specifically real estate property transfers in California, the distribution of them between new sales, resales of existing properties, and inheritances. And you can see that, yeah, going back to the mid 90s, we are at all-time highs on an annual basis from 2025. And you can see that it had been definitely going through an acceleration since 2020, which is just right in line with the great wealth transfer thesis regarding baby boomers passing on their assets to their kids and stuff. Yeah, very, very good chart that I found there. Yeah, it's not an overall wealth distribution taking place, but it's just the wealth distribution broadly. But you can kind of think about it as probably going to be similar. So it's like, yeah, that doesn't necessarily give us super specific information about annuities, but at the same time, if you assume that those households had their fair share of annuities, then yeah, there is going to be a natural amount of people falling off of policies that annuity policies that don't have benefits for their surviving successors. Some annuities do have death benefits and are not and otherwise. So it kind of depends a little bit. In fact, within that, let me. Looks like we're going to talk about FG next anyway. So let's go ahead and move on over to that topic there. Because like FG themselves, they sell a mixture of different products that can kind of have different effects depending on what happens with inheritances. So because like obviously they sell fixed index annuities, which fixed index annuities have a specific period of time that they are in effect for before they mature. And then they also have multi-year guaranteed annuities, which are basically like more traditional fixed rate annuities. They also typically have a more defined period of time. In fact, they're very much kind of like a CD, but with extra features essentially attached to them. But they also, FG, one of their smaller portions of their business is Index Universal Life, which is um, full life insurance, which that does tend to have surviving death benefits, which means that if you do pass on your assets to your kin, then there, depending on the contract signed there could be benefits passed on to their kids there. So there is a little bit of an effect there for FG, but in general, I was kind of just sending that to you as kind of like a broader um, confirmation of the fact that the assets are being passed on, because there was some debate when it came to the idea of baby boomer wealth and the great wealth transfer. There was kind of different arguments about it. It's like some people thought it as like a wave of wealth that would basically be inevitably coming, but then other people saw opportunities for, like, depending on how you pass down the benefits, those assets could actually just continue to be concentrated further into those families without really actually being sold. Because some people think of it as like, oh, well, if all the kids inherit all the houses, well, that means all the houses are going to go onto the market. And it's like, well, you don't know if the kids are going to continue to own the houses and rent them out, or sell them off to some institution, or what have you. And it's sort of the same logic with annuities. It's like if a kid inherits an annuity contract, maybe they don't want the annuity contract, and so that maybe they attempt to kind of secondarily market out of it. Depending on the annuity, because that may not be possible. But here, looking at FG, so here we're looking at the presentation. We're going to go through a lot of details of it. Just kind of quick refresh about their product lines here, which I was kind of just talking about a little bit. They have their retail annuities, which is the annuities that they sell to retail customers, kind of like typical mom and pops, middle income, upper middle income kind of class range. Fixed index annuities, which is a little bit of a confusing misnomer because it calls itself fixed, so it kind of gives the idea that there's a consistent crediting rate being given into it, like a fixed interest kind of bond, so to speak. But that's not exactly what's going on because of the fact that they are indexed. So essentially, a customer chooses an index to base their annuity crediting based on. Most commonly, it's the S&P 500, but technically, either you can select amongst a range of different types of indexes, which means that they have an annuity contract that will then increase in value. It will get its crediting based off of the performance of the S&P 500. And to clarify, that doesn't mean it gets the S&P 500 return. So, like, if just because the S&P 500 goes up 20% a year, that doesn't mean that the FG has to then pay out a crediting rate of 20% on that. It may only be 5 to 10% or something for a 20% return. There's going to be like a structure where they say if the S&P 500 does this kind of range of returns, then you're going to get this credit. If it gets this range of returns, you're going to get this credit, and that's how it works. so that it is limited upside. It's basically like a limited upside engagement in the equity markets, but it also has downside protection for that retail customer as well. So that's partially why it's called fixed as well, is that there is a fixed principal aspect to it. So there's a fixed terms in terms of how it credits based off of the return. So maybe you get a 3% credit for whenever the S&P 500 gets like at least 5% annual return, and maybe it's a 4% credit if it gets at least a 10% return, and maybe it's a 6% credit if it gets between 15 and 20% returns or something like that. But then it's going to be a 0% credit if the S&P 500 returns a negative return. But they also don't lose their downside, right? So you can see like that's kind of like how it's structured. And I just made up those numbers just to be clear. Like that's not specific to FG's pricing. I don't actually know really like the range of pricing, but it's like that where the customer gets a limited exposure to the upside of equity markets while getting protection on the downside. But it's a limited upside, so they're essentially giving away parts of those returns, and then those returns are given to them in the form of fixed income, but then it's credited to the account, which essentially compounds the size of the value that they have in there, which then grows it over time. And then all those benefits are then grown tax-free internal to FG, which is another reason why it's beneficial to retail customers. In fact, its tax benefits is probably one of the more beneficial aspects of annuities to retail customers. Like that's one of the big reasons that like various investment advisors would suggest annuities to various retirees. It's partially for the tax benefits. So anyway, that's how fixed index annuities work, which is like their primary product that they sell the majority of. But then also in 2024, they started selling registered index linked annuities, which are very similar to fixed index annuities. However, they are based on a more limited range of types of indexes that are publicly registered indexes, so more specifically like the S&P 500, whereas with fixed index annuities, technically you can create a range of different types of indexes specifically for that. So this has limited types of indexes you can use this on. But like I said, even with FIAs, the S&P 500 was already probably the most common one to use. So that aspect isn't really too different for RILAs compared to FIA. But one of the other things that is extra different for RILAs compared to FIA is that there is not downside protection for FIA. So there is a wider variable range of returns that the retail customer can get for RILA, which means that it can be a safer product for FG to engage in, and can also mean that there's going to be lower amounts of crediting that they themselves have to pay for when the market's kind of going against them. So it can be quite profitable of a product, but is also riskier for the consumer too, I guess you could say. If they basically wanted higher levels of direct equity market exposure. And then they also sell the multi-year guarantee annuities, which are closer to more traditional fixed rate annuities, which means that like you sign the contract on the day and then you agree that, okay, I want a 4% crediting rate or a 5% crediting rate, and I'm agreeing that for the next 5 years, I'm going to get that 4 or 5% crediting rate to my annuity, and that's going to be what it is. And then if I continue to hold my annuity after that, well, it might be a floating rate after that. So that's a little bit more of like just a straight up fixed contract type product, which this is in their what they call their opportunistic category of products. So like these are their core products, the things that they try to sell more of in every quarter always. And then MYGA would be something that they would sell more of if they are either not seeing as many sales in their core products, or maybe because the pricing dynamics between the different types of products they have is just a little bit less convenient for them in that quarter, then maybe they'll sell more MYGAs for that reason as well. Jeff asks, casually wondering if booms are expiring, maybe their time to acquire an annuity may have peaked and maybe that time is behind them, maybe no correlation. Somewhat. I mean, I know I kind of commented on it at least a handful of times here or there in the last year or year plus, is that we really are kind of at that peak point as far as the baby boomer retirement. Like, you know, it was kind of a 2020 to 2025 was kind of really where like the bulk of that transition was going to occur. Like, you know, the baby boomers are still all around, and there's still there's still plenty of people retiring on an annual basis here every single year because it doesn't just like drop off a cliff in terms of like the size of the generations per se. But in terms of that kind of like growth of the percentage of the senior population as a percent of the total population, we have basically peaked at that point. We're going to stay at this peak level for a while, but in terms of that like extra tailwind we are getting from the demographics, we kind of really have mostly passed through it. And so in terms of like the boomers themselves and like whether or not they're acquiring annuities, it's they're kind of past the age where most of them would be typically acquiring annuities. Now, I would say that that kind of applies to the traditional time frame to get annuities because like the more traditional time frame I would say to be getting annuities is probably like 55 to 65 or 55 to 70 is probably kind of like the more traditional time frame. And because like pre-retirement, you want to include like a decade pre-retirement because like I said, a huge benefit to annuities is actually tax deferred growth. So like really one of the like the traditional way that like an investment advisor would then start to um, recommend them to people would be like when they're in that last decade prior to retirement and they're really trying to think of like how can we really eke out a little bit of extra juice before retirement. And so an investment advisor will be like, well, we can get some tax deferred growth in your fixed income part of your portfolio. So let's get you some annuities, and then once you kind of get into 65 to 70, that would be then the kind of transferring of other equity assets time frame into income assets because then you want to be able to live off that income. Now, I would say that the boomers have been a little bit different from other generations previously. And I think that partially has to do with the fact that they are the baby boomer generation. They are the big generation. And so that the size of the baby boomer generation has had just dramatic impacts on different parts of the economy throughout the many decades of their kind of prime working age life. And that includes a big push into equity ownership. Right, like the equity ownership at the retail level has expanded since like the late 70s, and then really accelerated in the 90s after like electronic brokerages started becoming all the rage, and a lot of the kind of like barriers to entry started breaking down, fees and stuff like that. But the point is like equity ownership is at all-time highs. And there's very, very strong arguments to be made that the boomer generation was a huge driving factor in that. The Gen X has their own significant impacts on that as well. But the baby boomers are a big aspect of that. And so there are a lot of baby boomers that are just so used to owning equities that they've kind of moved past the 65 age and now they're closer to the 70 age, and or plenty of boomers that are getting closer to 75 at this point as well, depending on where you kind of like put the range of the bands of where you define the boomer generation exactly. But there are plenty of kind of older boomers who should have moved more significantly into fixed income by now that haven't really done it yet. And like I know plenty of these people. There are plenty of people who like if you looked at the same age group 20 years ago, they would have a much higher significant portion of their portfolio in fixed income than they do currently. 20, 30 years ago, 40 years ago. And like I said, there's lots of factors that kind of cause this. I think baby boomers have a big impact on this. Interest rates have a big impact on this. The fact that they were low for so long has a big impact on that. But I'll say that the baby boomers themselves are probably a part of the reason the interest rates were so low as well. There was what they referred to as a glut of savings, and that savings came from the baby boomers. And if you have a glut of savings, it pushes interest rates down. So it's like there's a lot of factors, and a lot of those factors kind of correlate to each other. But yeah, we have in many ways moved past the peak kind of traditional time frame for annuity purchases for the boomer generation. But like I said, there was kind of almost, even though there was a larger amount of them, there was almost like a drag of a kind of reluctance for a larger amount of those kinds of people to go into these types of products versus say dividend stocks or something like that. So like people love to own equities these days. And if you're owning equities, that means you own less FG products. And so if I think about like how that affects things for FG, one, that means that the boost we saw from 2020 to 2025 probably wasn't as large as it could have been. Like it could have been much larger of a sales boost. And maybe we'll still get those sales over time. That's the thing, is like maybe there's going to be a larger bleed in the 70s for the boomers, maybe, and maybe even into the 80s for if they continue to live particularly long as well. So yeah, who let the boomers know that stocks only go up? Exactly. It's like they're the generation that basically got convinced of that. And so there has been heavy implications from that kind of change in the kind of social approach to how you think about saving for retirement. And that's one of the reasons that like also FG, if you look at like a lot of the details in terms of like how they explain their own market, they talk about how they angle towards a lot more towards those middle income households because they know that like once you start getting towards like upper middle class and into the upper class, really it becomes so much more about equity ownership. That's like definitely like a huge aspect of it. And but then, like I said, plenty of investment advisors still try to advise a lot to those upper income households that they should still consider annuities because annuities are quite useful for tax deferred growth. In fact, like if you do look in the Federal Reserve data at like the ownership distribution of annuities, it is still upper income households that still own the majority of annuities. But that also comes down to just the distribution of wealth itself, that they have more wealth, so of course they have more annuities, kind of thing. So anyway, good questions. Always happy to kind of discuss those things. Yeah. But yeah, continuing on with the kind of like yeah the basic description of the products. We described the multi-year guarantee annuities, which are kind of more traditional fixed rate annuities that don't have anything to do with an index. But then they have their pension risk transfers, which is corporations and other entities transferring their pension liabilities over to FG, so that they basically have direct immediate fixed income liabilities that they have to pay out to existing current pensioners, but then getting the capital that those companies had previously allocated for their pensions. And then they, being an investment professional, has a little bit more of a better strategic advantage of being able to manage the assets relative to those liabilities so they can then capture a spread relative to the fact that they are then paying out immediate annuities. Because the difference between those is that with the retail annuities, you're receiving a lot of capital up front, and then you have to pay out small amounts of capital over time, pretty immediately, and then you have to pay back a significant amount of that capital later. Whereas pension risk transfers, you receive a significant amount of capital up front, and then you're not going to pay out a large amount of capital later, but then you're just going to basically amortize the total amount of the capital that you were given out over a more consistent basis. So like basically there's huge inflows with retail annuities up front, and then at some point many years later there's huge outflows, and then you're basically just hoping to make significant enough returns as FG in the short run to then be able to make a profit on that in the interim. Whereas with pension risk transfers, you get a huge inflow up front, and then every single quarter thereafter, you have consistent outflows over the course of the pensioners, existing their life, their pension. And then also pension risk transfers also include some surviving benefits for the pension survivor as well. So those have some life contingent aspects as well to them. But so that's kind of like the difference between these products is that like this kind of has these timing differences in terms of cash flows. And then life insurance is also a little bit different, right? Like life insurance, you don't receive a huge capital inflow up front. You just receive premiums on a regular basis to then have a contract in place where you potentially have to pay out a significant capital outflow at some point in the future, right? And then the question is about how much that outflow is and how many years in the future it is, because it's life insurance. And it is an indexed life insurance, as I was saying before, so it does have an up and down potential loss of principal aspect to it, which makes it different than normal life insurance. So it's like think about normal life insurance and then think about fixed index annuities and kind of like combine the two, and that's kind of like what index universal life sort of is. And then funding agreements. Funding agreements is somewhat similar to pension risk transfers in that it's an institutional product. It's a contract between you and another company rather than a retail consumer. However, it is unlike a pension risk transfer where you get a big capital inflow up front and then you have to pay out regular capital outflows on a regular basis. Funding agreements, you get the capital inflow up front and then you have a big capital outflow at some point later in the future. and then similar to the retail annuities, you're just hoping to earn returns in the interim to then account for your profit as a company. So that's kind of the difference between the different products as you have here, and you can see that like how they diversify against each other comes down to those kind of cash flow dynamics. Like some of these give them big inflows up front, and others don't give them big inflows up front. Some of them have big outflows years later, and some of them don't have big outflows year later. And then some of them have consistent outflows in the interim, and then other ones give you premiums in the interim. So you're not even an outflow, it's an inflow, right? So you can see like that's kind of like the way these products are different from each other and the way they kind of diversify against each other. So long little basic description of kind of the types of the products, but I could kind of tell from some of the conversations we were having in the Discord that it's easy to get these products mixed up with each other, especially how they compare with some of the other annuity companies and the annuity products that they have. So that's why I was like, let me just go through each of these products and kind of try to explain basically how they work. And like I said, explain those kind of cash flow dynamics to them, I think really helps explain that. So here shows the gap reserves. They have 57 billion worth of in-force liabilities for that, and in their that they have gap reserves in their liabilities for 55% of that being for index annuities, 14% for pension risk transfers, 11% for funding agreements. So if you kind of combine the pension risk transfers and the funding agreements together, that's 25% for those institutional type products. Only 6% for life. So you can see like life insurance is definitely like the smaller portion of their business, and really it's kind of like the legacy portion of their business. They still do those index universal life contracts, but they used to also do more traditional whole life contracts, and they still have some traditional whole life contracts on their books, which is some of what this is, but they're no longer selling those contracts, so they're kind of just letting those work their way out of their products. And then they have the immediate annuities, which is those MYGAs, those kind of traditional fixed products, which is also a relatively small portion of their reserves. So details kind of related to that. The weighted average time remaining in their surrender charge period they have here as 5.3 years. Now, what that refers to is that like a huge portion of these, not all of these, because it kind of depends on the type of product. Like, it doesn't apply to pension risk transfers or funding agreements, but for index annuities, for the immediate annuities, and the fixed rate annuities, they do have surrender charges, which means that like if you agreed to a say 8-year annuity contract, but then in year 2 you decided you want your capital back, there is an aspect of that contract where the consumer can get their capital back. However, they're going to then have to pay a surrender charge, and those surrender charges are staggered by years. So it's basically like saying that if you try to depending on the contract, it might be like a year or two where they can't get it back, and then maybe after a couple of years they can start to get it back. But then also B, it might be that you have a 10% charge in year 1, and then maybe a 9% charge in year 2, and then 8% charge in year 3, so on and so forth, so down the line there. So when they say a 5.3 year weighted surrender charge period, that's kind of what they mean here, is that on a weighted basis across all of their liabilities, they have about 5.3 years of time that they can work with, where they either the person has to leave the annuity in there, or they're going to get the surrender charge. And then they also show here the average remaining surrender charge on the account value is 7%. So that basically means that like if the entire portfolio, if the entire portfolio worth that could pull their money out, that is outside of that surrender period, could pull their money out, did so, then they would get 7% back. Which is pretty heavy. It basically just shows that they do have like a buffer against people trying to pull their money out. And these contracts aren't really designed for people to pull their money out in the first place. These are supposed to be long-term contracts, which is kind of why it makes it different than say like banking, where like in banking you're also invested in a bunch of fixed income products on your asset side of your balance sheet, but your liabilities are very short term. You have depositors who might want to come pull all of their deposits out of their contract in the next month or two, or something like that. And banks have some long-term liabilities as well, but the point is the majority of their liabilities are very short term, and that's part of why you can occasionally have bank runs, is that people freak out about that fact when they realize that the assets are much longer duration than the liabilities, and then suddenly there's concerns that the assets aren't going to come back fast enough to pay back the liabilities. Well, insurance companies basically do the same logic where they have a spread between the time frame of the assets and the liabilities, but they have contracts in place on those liabilities that makes it so that the liabilities can't just flee away, causing them to have to call back those assets. So that's basically kind of how that works there. Being in large markets, we've talked plenty of times about these details in my original FG video, so we don't need to talk too much about that. I don't really want to talk about every detail of this presentation anyway. Just kind of like some specific details of it. One thing that they have been talking about a lot more in the last year or two, especially, is their own distribution, which is basically the part of the sales process for the annuities. There's the independent marketing organizations that basically say, well, there's this company that sells annuities, this company sells annuities, and they have these products. It's basically like the company that helps market their products to the different investment advisors that sell the annuities to the consumers. They have been making significant investments in those marketing organizations over the course of the last several years. As you can see here, about $700 million in cumulative investments that they've made as of the end of this year. And those cumulative investments have ended up in about $80 million worth of EBITDA for fiscal 2025. And it's worth noting that that's basically pure profit. It's basically pure profit. Like, it shows up in their revenue as like about 80 million, and it shows up in their EBITDA as basically 80 million. So it is highly, highly accretive to their profit margin the more they can grow this portion of their business. And then also they have their kind of list of different goals that they've been kind of working towards, including trying to raise their ROE, raise their ROA, raise their assets under management. But in the last year or two, they've also have started talking a lot more about an extra goal that they have, which is the expansion of their fee-based earnings. And their own distribution and investments in the own distribution seems to be one of their main kind of strategies towards growing those fee-based earnings. So, and what that means, like what do I mean about fee-based earnings, and what's the point of that? Fee-based earnings are earnings that you get directly from the sales of the products rather than from the spread on the investments of the liabilities you took on, right? So like the huge portion of FG's income, like 30 to 40% of it is investment income, and then like another 30-40%, it's like 40 percent of it is basically premiums, which is sort of like an amortization of the acquisition of those liabilities in the first place. So essentially, if you combine the two together, it basically means that you have like 85% of FG's revenues comes from just taking on those liabilities. In some form or another, it comes from taking on those liabilities. It's either from the direct taking on the liability itself, or it's from the income earned from the assets on the other side of the balance sheet from taking on those liabilities. Whereas these earnings are not about that at all. See, like you get them from the sales, which those sales result in you taking on those liabilities. However, those sales only result in you taking on the liabilities if they're to you. These fee-based earnings aren't necessarily just their sales. It could be anybody's sales, right? Like these independent marketing organizations, they recommend annuities from several companies, not just FG, but all sorts of other companies. So the point is, like, they've kind of taken a stake in a horizontal aspect of their business model. It's like it's a piece of how their products are sold, but now they can essentially profit from other people's annuity sales as well, not just necessarily their own. Though of course you want to try to further expand your own sales as well. So the point is, like, it's an expansion of types of fees, of the type of earnings they receive. And then also one aspect of why fee-based matters is that it's because of the fact it's not related to your investments. That means it's not going to be affected by changes in interest rates. Like, this isn't going to be spread based, and therefore if rates go up or go down, or if the yield curve goes up or goes down, or if credit quality goes up and goes down, causes interest rates to go up and go down, that doesn't affect this at all. That doesn't affect the earning of it. Now that might affect whether or not how much retail investors are buying in annuities in the first place. So that it could affect the demand for those sales a little bit, but it's not going to affect the cut the FG gets of those sales, if that makes sense. So that's why fee-based earnings matter. That's why they've suddenly started talking about this a lot in like the last 2 or 3 quarters in particular. I've noticed that they've really been accelerating their talking about this. Also, it kind of relates back to some of the actions they took in the most recent quarter because they did they are they are selling off their the FG Bermuda reinsurance to Ancient Financial, and they're going to be requiring the capital that they had from that investment. And then they've talked about other ways that they could reinvest that capital. One of the only things that they explicitly named potentially for using that capital for is further investments in their own distribution. So I'm talking about it here because I do think that we will probably see further investments in the next quarter or two, and that will likely lead directly to increases in the revenue and in earnings. Which, like I said, it's a very small amount of revenue right now. Like it's a very, very tiny amount of revenue. We're not talking about like a huge amount. If I come over to like their my little income statement modeling that I've been doing on them right here, own distribution revenues right here. Yeah, 2025, $89 million revenue, and it was 81 million in 2024, and that was when it first started showing up there. So it's a very, very tiny portion of their revenues. What is that? 1.6% of the revenues. However, like I said, it's almost 100% profit margin. Like it's like a 90+% profit margin section of their income statement. So while it is a very, very tiny portion of their revenues, it basically flows directly down to the bottom line, which means that it can really, really help with their goals of increasing profitability. So that's why I think it's, even though it's seems tiny, it seems kind of like a tiny, tiny little portion of what they're working on right now, and it is to a certain extent, but it could have a pretty big impact down the line here. So good stuff on that front there. Uh, I don't want to talk too much about this today. We'll keep going because there's I'll talk about the risks. Go down. Where do they have investments? Okay, so obviously, just come over to FG. Obviously, it's been not pretty. It's been not pretty in the last handful of months. Last year, really, the whole last year has been not pretty. Pretty much exactly the last year or so. Is almost a year ago exactly is when our trials and tribulations began here. And I was definitely buying almost like every other day in January. Really, really kind of hoping that these earnings were going to be better than they were for sure. Which I mean, they weren't the worst earnings. Let's say that's the thing is like this wasn't really like a bad earnings. It just definitely was not particularly good, and there was enough not great about it that it led to the declines we saw. And it was a miss. It was a miss on the earnings side, though it was technically a slight beat on the revenue side. So it was kind of like a weird mixture in that regard. But it does seem that they're focused a lot more on profitability, and also that kind of relates back to a lot of the credit concerns because obviously private credit has really blown up as a concern in the investment world. And I do appreciate them for finally including a few more details in their earnings reports here, as you'll see here shortly, to actually try to directly address those concerns. Because I had been talking about these things in the last few of the earnings reports. I had to kind of like discuss the kind of split of their portfolio by different asset classes, and I had gone through the portfolio and talked about like which parts I defined as private credit versus not. But it's here now they're explicitly showing exactly where the private credit is, rather than you kind of have to say, well, this category could include private credit, and this category could include private credit, and this category include private credit. And so all together, I think it's probably like 15 to 20% or so, which is what I had said previously, by the way. So I ended up being correct on that front. So I want to, not to overly toot my own horn, but I had previously said that based off of the distribution of asset classes and the way that they had kind of described their portfolio, that it seemed like they had about 15 to 20% of private credit, and shows up that they do in fact have 20%, which is good to hear because I had seen Seeking Alpha articles where some people seemed to completely misunderstand and believe that basically like 90 to 95% of their portfolio was private credit. Like I had literally seen that online about like an article about FG, like not just about annuity companies, like an essay article about FG where they had claimed that it was like 90 to 95% of their portfolio was private credit because they basically said that everything that wasn't government treasuries, cash, or agencies was basically private credit. And the reason they thought that was because of the fact that like 85% of the portfolio is originated through Blackstone, or 80% at this point, which is fair because like it's a private credit entity who sources the vast majority of the assets in the portfolio, but that doesn't mean that it's all private credit because first of all, not everything that Blackstone does is private credit, right? Like Blackstone is a private equity group and they do a significant portion of private credit, but they're a private equity group, right? Which means that they do equity stuff. And also, for the record, it's not even that 95% of the portfolio is private equity either. It's like, more of it's private credit than it is private equity, actually. Because this is a fixed income portfolio. It's not really meant to have a significant portion of equity. We do have equity in the portfolio, but it's a relatively small portion of it. We're mostly fixed income. So anyway, fixed income, 97% investment grade, modest average credit related impairments of 6 basis points per year over the last 5 years, significantly below their pricing assumptions, meaning that like the way that they sell their products, when they price to the customers, they say, okay, we agree to give you this crediting rate, and we agree to give you these terms where we're going to give you this and this, you're going to give us this premium. That's what they mean by the pricing assumptions. And like they try to bake loss assumptions into their pricing assumptions, right? They try to bake their expectations about changes in rates and their expectations about losses on their credits into their pricing assumptions to the best of their ability, and to the best of what the market demand will bear, obviously, because if your competitors are offering different things, well, then you can only offer whatever you can compared to your competitors. But within that, the point is like they try to account for these things in their pricing already, but they're actually doing better than that already. 6 basis points is incredibly low. I'll point out that I think that in private credit on average over the last like 10 to 15 years, it's been like 10 to 15 basis points or something on average per year, which is also incredibly low, by the way. But like if you talk to people who like talk about the private credit issue, they'll be like, oh well, private credit promised like 8 to 9% annual returns at basically low loss levels, which means that it's low risk, and it means that on a risk adjusted basis, it gives you equity like returns for fixed income products. That was the promise that private credit was giving, right? And then the actual performance the private credit returned was actually like 12% over the last like 10 to 15 years. It was mostly more like 12% with and by the way, the 8 to 9% returns was expected to still have like 1% losses or something like that, like 0.5% to 1% losses. But what they so it was promised 8 to 9%, with 0.5% to 1% losses, and then what they got was 12% with like 15 to 25 basis points of losses. That was like the 10 to 15 years prior to the last two for the across the private credit industry. And that's part of the reason that so much money continued to flood into that area, is because the returns were excellent, the losses were low, and it didn't actually make a lot of sense relative to financial theory because everyone was saying, well, why are they getting such good risk adjusted returns? It doesn't really make sense, yada, 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 yada. And that's why a lot of people were concerned about it. So within that concept, I want to point out that yes, the losses in private credit has started to increase a little bit more, and the returns have started to go down. So now private credit returns are now back down to more like 9% returns, but the losses are still low, even with the headlines out there about some of the kind of idiosyncratic bad funds that have had redemptions here. There, there's headlines out there, but across the whole private credit space, everything is still basically pretty low, pretty low as far as actual losses. So anyway, that's the whole industry. But then I just want to point out that FG is at 6 basis points, 6 basis points over the last 5 years, and that includes 2025 and 2024, where there has been more losses in the private credit industry broadly. So not only is private credit doing better than I would say than I think the average kind of like person out there probably thinks private credit's doing compared to like some of the negative headlines that are out there over the last 6 to 12 months. But FG appears to be like incredibly high class compared on a comparative basis relative to that. Now, it's worth noting that the returns that FG gets has been significantly lower than private credit too, because they themselves, like I said, it's only 20% private credit. So 80% of their portfolio is not private credit in the first place. So when they say 6 basis points, they're talking about across their whole portfolio. But I point this out because they are being treated as though they're basically like private credit. So here, FG, put EPC, was it? Yeah, Virtus Private Credit Strategy ETF. Put this separate scale here. And then I know I'd shown this one as well, BXSL, which is Blackstone Secured Lending Fund. It's not exactly private credit. It's not only private credit, but it's secured asset lending specifically from Blackstone, which means it's very, very comparable to the type of assets that FG has. And so the private credit sphere here kind of really began in August. So let's kind of just zoom the chart back to August a little bit. So it begins there. And like, look at how correlated these are, right? So there's it's clearly obvious that the market is looking at FG and basically saying private credit trash. Like that's what the market is doing right here, and it does not make sense. It does not make sense. Like I said, it's like, one, private credit is not doing as bad as a lot of the headlines think it is on a total combined basis. Two, FG only has 20% private credit. Three, that the 100% of the portfolio has only had 6 basis points of losses, and if you just assume that the 6 basis points of losses was 100% in private credit and no other losses was anywhere else, well, then that means that it would be 5 times that, so it would be 30 basis points, which would kind of put you in line with other private credits. So you can see it's like not very big of a problem. And then also, it goes beyond that. There's other parts of these risks that people are worried about. Kind of a legacy risk people were worried about. Obviously, people were more worried about this in 2022, 2023, and even in 2024. But office exposure in commercial mortgages and commercial real estate lending, only 1.6% of the total portfolio. And then also they were asked in the call about software exposure, since software lending in private credit is one of the big worry signs right now. Obviously, they themselves say that it's less than 5% of the total portfolio is software exposure, and then within that, they say that since it's a big category, they think that it's less than 1% that has some potential for disruption or intermediation risk. Now, they say 1% of the portfolio has some potential for disruption or intermediation risk. That doesn't mean that they would expect to take a full 1% loss on all of that. So just going to show that, like, their portfolio is not really the same as the portfolios that a lot of people are talking about when it comes to risk, and yet it's still being treated as though it's basically the same thing. So long way to say that, I'll be damned at some point for having said it, but this too shall pass. This too shall pass. Or at least I feel like it must. I feel like this has just gotta be a complete blowover at some point or another. It may take some time. That's the thing, is I don't know how long it's gonna take for this private credit scare to blow over, because there is legitimate concerns about aspects of the private credit market. Like, I understand why people are concerned about it. Like the high levels of software exposure in some of those funds is very worrying, and like that is what some of the headlines in the last week have talked about. Like, there's some funds that have had to take very, very significant losses, and other funds that have had to gate their redemptions. I know Blackstone in particular. There was Blackstone had redemptions on their BCred fund this last week, and they actually did something pretty commendable where they had it in the contract where they could technically gate the fund at 5% redemptions, which means that, like, once at least 5% of the fund had asked for redemptions, they could basically contractually say, okay, no more redemptions for a certain period of time. And then Blackstone actually allowed it to go higher than the 5%. I think it was about 7% or something that they allowed for redemptions for, and they just funded it. They just funded it through. They said, fine, you want 7% back? Fine, no problem. Here you go, 7% back. And they funded it through some other capital raises, and then they also got capital from their employees to help plug that hole as well. So they did two really good moves, Blackstone in particular, when they were facing redemptions this week. Is that they, one,
they allowed for basically the amount of redemptions that was asked for rather than just what they were legally required to do. So that was one really good move. And then two, they plugged the hole with employee capital. Employees basically came in and helped fund the flood, which is like insider buying basically. They basically came up and showed support. Now, I will say the employee aspect of it. Now, for the executives, for the upper level employees, then I would consider that like a real show of confidence. But lower level employees were part of this as well, and it's almost for certain that there's probably a cultural aspect of this where like if you want to not be given the side eye at your next compensation meeting, right, or your next bonus discussion, they're probably going to be considering who did or did not show confidence in the company, right? Like maybe not explicitly, maybe it's only implicitly, but I bet there was pressure for employees to contribute. I'm willing to bet. But nonetheless, like I said, the combination of those two things very, very good. There's other funds at Blue Owl that have not been doing similar, right? So it just goes to show that Blackstone appears to be one of the ones that's handling the situation, at least in terms of like handling the public perceptions of it. I think they're doing a lot better of a job than say Blue Owl. Blue Owl has been kind of a total disaster. On a comparative basis, whereas Blackstone has been doing better. And Apollo, I would say like the CEO of Apollo, Mark Rowan, has also made various comments that I think is a lot better, a lot more responsible, a lot more calming to the market in a general sense. Long way to say that I still feel reasonably confident with Blackstone's underwriting quality. I know that like the opacity around the underwriting is one of the reasons that people don't like the private thing right now, is that they're concerned that you can't really see the quality of the assets well enough. But I'm just less concerned about that. I think that Blackstone is well incentivized to be worried about the credit qualities. And yes, there's the payment in kinds as well. That's one of the other things that people talk about, is that in 2022 and 2023, is as interest rates went up, and as some of these companies started to be strained a little bit more, they basically stopped paying interest in cash and they started paying interest in small additions of equity onto the company, or into increases in principal on the loan that to be paid off out years in the future, which is called payment in kind payment. And that's another thing that people have been worried about, is that there's been increases in PIK compensation over the course of the last years. And Blackstone has had, on a relative basis, some lower levels of PIK compensation compared to others. So here coming down, they have this slide where they explicitly focus on the private credit portion of their portfolio, which I thought was really, really good. They finally had like a little bit of some direct addressing of this issue, since it's basically been like a year at this point that this has been kind of like slowly becoming a concern in the market. And as we kind of already talked about, 20% of their portfolio is private origination versus non-private. And then as they show here, private origination quality, 92% of the private portfolio is investment grade. So very, very strong investment grade quality. I think what did they had said? Is it 97% of their overall portfolio? Yeah. Oh, fixed income is 97% investment grade. That's a little bit of a caveat because it's only like 90% of their portfolio is fixed income. So that's fair. Technically, that's going to be a little bit lower than that. So it might be like 89% of the overall portfolio is investment grade, because that includes the equity portions of the portfolio. So that's a little bit different, technically speaking. But yeah, 92% of the private portfolio specifically. So 92% of the 20% is investment grade, which is very, 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 very good. Private origination, a key component of our investment strategy. Approximately 11 billion of our portfolio, of the retained portfolio to be specific. We utilize Blackstone's best-in-class origination, underwriting, and structuring teams to source high-quality pools of physical and financial assets. Includes corporate and commercial lending, consumer loans, real estate, and other real asset exposures. Most have long performance history over multiple market cycles, providing observable data for thorough underwriting. Private origination allows us to mitigate our credit risk through diversified instruments with stronger covenant protections. From a ratings perspective, and by the way, what that means, by the way, is that like if you invest in public corporate bonds, right, Like that's like what a lot of the other portion of their investment portfolio is. It's just a publicly traded corporate bond. Publicly traded corporate bonds, because they're publicly traded, which means that they can be transferred from owner to owner in a public market. That means that the terms surrounding that bond have to be loose enough that basically all the different people who could be owners could all want to own it and could own it. And that refers like specifically to covenants. So like if you work in credit and underwriting, covenants are basically like rules put in place on debts that make it so that the person who you owe money to can keep monitoring the situation. So like I work in commercial banking, so like I totally understand how this stuff works. Is like we put covenants on loans, and we have to put them on that, and we put all sorts of covenants on loans. Like for example, we put covenants on loans that says that they have to give us their financial statements so and so many days after so and so period ends and whatnot, and that basically ensures that they're giving us their information on a timely basis. And two, that means that we can then see the progress of their financials on a regular basis to make sure that everything's going well. And then we might also have covenants in place, like performance covenants, where it basically says that you must maintain your debt to EBITDA level at a certain level on a regular basis every 3 months or so. And if not, then you have 3 to 6 months to get it back under that level, or we're going to call the loan. Things like that. So like the covenants are basically like rules that you put in place to protect the lender from the lendee. That's basically how that works. And so in publicly traded corporate bonds don't have very strong covenant protections because they have to be loose enough terms that the bond can be traded. So private credit, that is one of the benefits of private credit, is that you can actually have stronger covenant protections. Now, like I said, it's not public, which means that they're not public companies most of the time too, which means that the Blackstone might be getting all of the financials, but maybe not FG is getting all of the financials. So there is a little bit of like a bit of a gradient there. There's an opacity problem there, and that's one of the things that people don't like about it, is that you can't quite see inside to really get a super fine understanding of just how well everything's going. But if you rely on Blackstone, and if you're confident that Blackstone cares about those things enough, then Blackstone has very strong covenants in place on basically all of those loans. And those covenants might include the ability to do the payment in kind thing that we were talking about before, which is why those things exist in the first place. And that's the thing, is like a publicly traded corporate bond, there's no flexibility. There's no flexibility in a publicly traded corporate bond. You're either paying your interest or you're in default. That's it. Period. End of story. There's no middle ground. Whereas if you do a private loan, there's a lot more flexibility. There's the ability where, like, if something's going wrong, the lender can maybe try to help you out, and that has good things and has bad things. Like I said, like the payment in kind thing, that's them kind of framing it as a bad thing, because that's them basically saying like, well, you're just kicking the can down the road, and that means that you're not actually getting the returns that you said you were getting, and at the end of the day, that person's never going to pay you back. And it's like, well, that could be true, but it's also sometimes true that the customer just needs another loan for a little bit more period of time. Sometimes that's the case. And like I said, like I work in commercial banking, I totally know this is true, and it's like it's literally true in like how we operate in my bank. Like they've literally told us how that it is not always the most obvious answer to just not give the person another loan when they need it. Sometimes the best thing for everybody, for the lendee, for the lender, and for the economy as a whole, is to just give the person an extension on the loan. Sometimes that's the best answer. And so that's what I say is like private credit, while it is dangerous to just extend the loan, sometimes that's actually the answer that gets you your money back. So that's what I say is like there's flexibility. There's flexibility in private origination that doesn't exist in public credits. And so that's where like I said, there's a debate there. There's a debate there. There's positives, there's negatives about it. For the most part, I don't worry. I certainly don't worry about it as much as the market currently is. Let's put it that way, I guess. I'm not worried about private credit as a whole as much as the market is, and I'm definitely not worried about FG, a law, private credit as much as the market is. But then diving in, like I said, diving into that private credit origination from a ratings standpoint, they said here 92% of it is investment grade compared to 97% for their total fixed income portfolio. As they said there, 90% is rated by a combination of the top five NRS BROs, which are the rating agencies, Moody's, S&P, Fitch. They also mentioned Kroll and DBRS, which are some lesser known, more lesser common insurance raters, compared to 94% of the rateable assets in our total fixed income portfolio. So very strong ratings. And then basically what they're saying there is that a lot of their stuff is rated by multiple agencies. So it's not even just that like one rating agency gave that asset a rating. No, that there's multiple ratings. It's like basically like cross tabulation across these risks to say, okay, will everyone agree that this isn't super risky? That kind of thing. And then down here, they mentioned for the retained portfolio, Egan-Jones ratings are de minimis at less than 1%. They're mentioning Egan-Jones because Egan-Jones is a rating agency that was kind of a little bit in the headlines related to some of these private credit assets that have had problems recently with in Blue Owl and amongst others. Egan-Jones is a newer ratings agency that is much smaller, that has kind of come onto the scene in the last decade or so, specifically getting ahead by being a person to rate private credit assets that other people were not rating. And so, like I said, because of some of the losses that were taken recently because of Egan-Jones ratings, people have been focusing very heavily on that. So here they're kind of saying, hey, by the way, we actually basically hardly work with them at all. So don't worry about that. And even if they are working with them, there's a good chance that because of what they set up here, there's actually a very good chance that even if they on the 1% where they do have Egan-Jones ratings, there's a very good chance that Moody's, S&P, Fitch, Kroll, or DRBRS rated that asset as well. But nonetheless, relatively small. And then they mentioned here private letter ratings account for about 17% of the retained portfolio and undergo the same analytical rigor as public ratings. So yeah, that's basically what they're saying here. Like Egan-Jones is a private letter rating agency. So they do have outside of Egan-Jones another 16% essentially of other private letter ratings in their portfolio. However, those ones are also probably, like I said, being rated by other public rating agencies as well. So yeah. And then within the private origination, they have it in different categories: structured credit, CLOs. They talk about the way the CLOs are structured is structured in a way where you can actually take pretty significant losses and still basically make large recovery ratios. Another reason why I have pretty good confidence, generally speaking, in the way that they've kind of built their portfolio. It seems to me that like we would have to have pretty dramatically bad things happening in the economy for FG's portfolio to blow up. And like I'll admit, for in the last 6 months, like I've had to do a lot of research on the back end here to like really be sure that I agreed with that, because like I said, like that was what I felt for the longest time. But then as this private credit scare became a much bigger issue, I definitely have been doing lots more research and being like, man, am I sure? Am I really sure? Am I really sure that FG isn't going to have like some big blow up? But the more I look into it, the more and more I find nothing really to be worried about. So I don't know. Like I said, famous last words, I guess, and I'll be here making my culpas in the if when scenario that FG does somehow blow up or something. It's like I guess I'll be making all sorts of public apologies and all that jazz. But it just I don't know, put my money where my mouth is, and like I wish I wasn't so up to my gills already in FG so that I could be buying further into the weakness. And I mean, I don't know, I probably will at some point add more because I've had up to 20% before, so we're significantly below 20% now. So I probably will add more at some point, but I am trying to maybe wait to see if it seems like things are turning around a little bit here, because I am getting a little bit tired of throwing more money at it in the short term. But in terms, like I said, looking at the actual financials, I'm just not worried really. Just not worried. So anyway, we definitely didn't cover everything I wanted to talk about FG, but we kind of went further into detail in some other categories I wasn't originally planning to, which was good. It's fine. So nonetheless, we talked plenty of FG. I think I've kind of made my thoughts felt for the time being. Like I said, I am and have been working on kind of a revamp of the model I had made last year. I mean, I call it a model, but like last year, basically, I had put together a really like thorough, complex listing of basically all the information that they had listed in all their 10Ks, as much of the subjective data that they included as possible. And then I did build a model off of it. But then now I'm kind of trying to reorganize all that into a much more pretty and more thorough looking model that models out not just the income statement, but also the balance sheet and the cash flow statement for the next 10 years for FG within certain assumptions. Basically, I just want to have it so that all I have to do is plug in like what I expect the total annuity market size to do and what I expect FG's market share to be, and then it basically gives me full financials for that for the most part within that range. So I've already done most of the work on it, but I'm probably going to definitely be spending another week or two really kind of refining a lot of the stuff that I did here before I really kind of do a show giving a high detailed explanation of all of it. But I have been working on a lot of that in the background. And then, yeah, I'll be doing more economic analysis. Like I said, we did our business cycle analysis today, but I plan to do a stream going deep into the growth cycle, the inflation cycle, the employment data, the credit cycle, liquidity cycle, and yeah, so a little further deep dives, basically into as many of these individual lines as possible, going into further detail on that. But yeah, in the short term, we're just kind of riding the wave a little bit. As you can see in the portfolio, we have a huge amount of gold currently. That's as of last week because my weekly strategy shifts things around. So technically, I'll be going back down to probably more like a 15% level at the beginning of this week because gold does tend to shift around quite a lot in that strategy. Um, still writing industrials ETFs and energy ETFs and materials ETFs as far as the the macro sector momentum strategies going. It's been very cool to see, like I mentioned earlier in the stream, how we've had the exposure to the energy ETFs as we got the huge burst in energy prices, which I said it at the start of the stream, but not to brag, but I was making comments about oil looking opportunistically like something to maybe take a look at when it was in the upper 50s, and we're now like 60% higher than that. So, yeah, I mean, I didn't know necessarily that we were going to have the Iran war start necessarily, but there was plenty of telegraphing about the Iran war too. So it's also one of those other things where you would have had to have been foolish to think that there was impossible that something was going to happen in Iran, given the fact that we had been moving military assets there for like 2 months. So is what it is. But like I said, I didn't grab BP for my individuals in my portfolio, though I did, like I said, add it to the family portfolio. So I am long BP in the other portfolios that I manage, and I did have the energy exposure in the ETFs, but at least made the call. I hope at least maybe somebody who was out there listening to me maybe did take a look at some oil plays and got some larger exposure to that. But I do think it's pretty likely though that this fades back pretty quickly, all considered. I mean, because what it's not. To be honest, okay, there's a lot of details to go into on that, but a lot of people are concerned about the Strait of Hormuz being closed, and for the most part, the Strait of Hormuz is kind of like default closed for the time being. For I think from what I've heard, it's like one or two boats have been going through the Strait of Hormuz every day since the conflict started. But from comparative to previous issues with the conflict, most people have always worried about the Strait of Hormuz because they were worried that the Iranian government was going to mine the straits themselves, and they're not really capable of mining the straits now. And really, the concern is actually about drones attacking the ships. And from my understanding, the missile and drone launches in Iran are down like 90% compared to where they were a week ago. So, with all that in mind, it kind of makes me think that a lot of this volatility will probably fade over time. However, the speed at which it fades will depend probably a lot on the level of continued acceleration of further actions in the Middle East from the administration here in the US. So, if this really does end up being something that is only like a handful of weeks or maybe a month or two long, well, then this will probably fade out within 6 months' time. But if we're like doing some sort of significant boots on the ground thing, even if it's just for a handful of months, well, then this could remain elevated probably for at least a decent period while that's happening, because that would at least increase the chances that there would be some sort of significant happening there in the strait. So we'll see what happens with oil. We did get the pop that, like I said, I thought would sort of be inevitable. When I was making the call about it in the upper 50s, I wasn't even making like a specific claim where I'm like, oh, oil is going to go up here in the next handful of months. I was just saying that that price down there, 50s to 60s, is the point where you want to start looking, and that in the long run, it's not really a sustainable price forever. Like there basically has to at some point or another be spikes further up. But like that doesn't mean it can't fade back down. So yeah, interesting happenings out there in the world. But we'll see what happens over the next couple of weeks. Uh, Always planning for doing a show in the next 2 weeks, though it seems like lately it's been like every third week. But we'll see. Maybe we'll do a show 2 weeks from now. But I'll see those last thoughts there from Jeff though. Good listening to my thoughts. Agreed. I'm tired of throwing money at it. Might use it to offset WSM and Generac gains and then buy back in again. But for now, I'm just holding frustratedly. Yeah, that's kind of where I'm at with it. It's like I said, I'm because so it's I have other companies that I've been frustrated with too. Like I'm like super frustrated with in mode, and I've been very frustrated with PayPal. I mean, I've been up and down with PayPal, but especially since they threw the CEO out, I'm like super frustrated with PayPal. And I did sell significant chunks of the positions on those as a result of that. And with FG, and by the way, I mean now that my positions are a lot much closer to my targeted allocations that I have with my system, FG is basically the only one that's above my targeted allocation system right now, and it's not as high over that system as it used to be. I'm much more in a position to be willing to kind of buy and sell out larger chunks of certain positions. I'll have my kind of core position size in there, but I will probably make shorter term decisions to size up positions and then size them back down based off of on momentum and like where I think things are going in the short term and based off the value as well. Probably a lot more going forward. I haven't done that with FG, but the point I just bring that up in the context of FG because it's I could see myself maybe doing something similar like what you're saying there, where it's like maybe I could trim a chunk of FG because like I said, I added to FG. I added to FG significantly in January, and I added significantly also back in October, and then obviously I was adding at various points in last summer as well. So the point is like I can see myself maybe offloading a chunk of that which I added and which I essentially would be taking at a loss. But then I would probably throw back into it once it seemed like FG was starting to actually run back into positive momentum again. So it'd be like a temporary de-sizing potentially. But like I said, I haven't actually done that with FG. I have done that with InMode and PayPal and Lennar. Like I have done that with those ones, but I haven't done that with FG. I did trim Generac some more since the last time we talked. I do know I did that. But yeah, so I have been, like I said, definitely been rethinking how I kind of combine longer term parts of my strategy with shorter term parts of my strategy, and then rethinking, like when I want to add more to certain positions, and then I'm trying to be a little bit more liberal with my sell decisions, I guess you could say. I've generally always had tried to have a very stubborn hold on to your shares until you're really done with them kind of attitude. But I'm trying to be a little bit more easy come, easy go, I guess you could say, with some of my sell decisions. In terms of like I said, adding and subtracting decisions, not in terms of like getting rid of the position as a whole, but in terms of like sizing it up, I'm trying to also be very willing to size things down too, I guess you could say, within my allocation system. Just things I've been trying to change my thoughts around. But yeah, so that's gonna be it for today. Thanks for joining and chatting with me, Jeff. Always good to have you in the chat. Like I said, hopefully we'll chat again in 2 weeks, but considering how it's been the last several months, it might be 3 weeks, but who knows? We'll see. Catch you all next time. All right, bye.